My name is Steve Allen, Managing Member of SOP Advisors. This is a debut of a new weekly video segment we call Stuff Happens. This is in keeping with our basic thesis that stuff will outperform paper over the coming years. In fact, it's in our name, SOP Advisors, SOP, stuff over paper. In these short videos, we'll find some part of the commodity markets which we believe are misunderstood, underanalyzed, or overlooked. This week, we turn our attention to the shape of the oil futures curve. There's been some confusion as to what the futures curve represents. More specifically, people are pointing to prices out on the curve as being indicative of where prices will trend in the future. This analysis is flawed. The curve itself does not have any predictive value. The curve itself is rather just a snapshot of where forward projected prices are at present. So when you hear the media, politicians, or analysts say, there's no reason to worry about there's no reason to worry because prices for crude oil in the future are sharply below the current price. You should understand this analysis is deeply flawed. In fact, the CEO of Valero on their recent conference call addressed this specifically when he said those looking to future values, thinking that they can buy those products at lower values. The reality is that the curve is just rolling up, and we expect that to continue. And this chart that we're showing right here just shows that specifically. And as you can see, that it shows three forward curves. One when the conflict started, one a month later, then the current shape of the curve, the WTI contract curve right now. And as you can see that when the conflict started, the contract was the December 2026 WTI contract was at 64.78. 1 month later it was at 71.39, and that same contract currently sits at 84.54. So essentially, the curve is really telling us that inventory issues are becoming more acute, and prices, again, as the CEO of Valero pointed out, are just these prices just keep rolling higher. And again, this chart is just it shows that very distinctly. Darren, what's your thoughts on again the shape of the curve, but also what are the somebody that's followed the energy markets for decades, like what do you think the implications are of this of the curve and are in oil equities, but also just in the market in general?
Yeah, I think that, every couple weeks that this conflict goes on without any sort of resolution, the further end of the curve ratchets up a few more dollars, and that seems to be a lot more sticky than what we'll see at the front end when there is some sort of resolution to this conflict. It'll come off pretty quickly in the front months, but those prices further out on the curve are going to remain much stickier because the physical markets are kind of taking over from the financial markets, and that's what you're seeing. I mean, as we're drawing reserves out of the SPR and likewise throughout the world, those are going to be need to be replenished, and so the further end of the curve, year out, 2 years out, keeps grinding higher as this conflict goes on. And again, when the conflict does resolve, those months will stay relatively elevated, whereas the front months are going to be the ones that fall pretty substantially. And what that means for equities is that longer term cash flows are going to remain higher. And so for us as equity investors in SOP, that's primarily what we look at. So you've seen Exxon up 34% year to date. Chevron up near 30%, Valero's up 60%. I mean, these are going to come off some with a resolution, but again, the cash flows going out a year or two in 2 years is going to be much more elevated than it was pre-conflict.
Yeah, I guess the counterpoint to that would be is some are questioning, like, why are we not seeing more producers in mass start to ratchet up production? I mean, we've seen Diamondback a couple weeks ago, I think, talk about amping up their production, but we really haven't seen a lot of other producers. What are your thoughts on that?
I think some will. I mean, whatever they can bring on near term, they will. But I think that it's a couple 100,000 barrels at most, so it's at the margins. So talk about full year 2026 U.S. production. I think we'll be a few 100,000 barrels more than 2025, and that's about it. So, in the grand scheme of things, when you're losing 10 to 12 million barrels per day held up in the strait, a couple 100,000 barrels isn't going to be all that impactful when it comes to prices. So, again, I think production will ratchet a bit higher, but it won't be all that meaningful.
Okay, I think this is that's a good place to stop. I think this is just every week will come with some new part of the commodity markets, which in our minds are overlooked, underanalyzed, or under researched. But look forward to that to speaking to you next week and every week thereafter.
Thanks.